Meet Ryan. Ryan is 29 years old. He earns $87,000 a year, works in financial services in Dallas, contributes to his 401k every single paycheck, and every morning before he makes coffee, he checks the stock market on his phone. Not because he is a trader, not because he watches tickers all day. He checks it because, like most Americans, he absorbed a belief so early and so consistently that it stopped feeling like a belief and started feeling like common sense. The belief is this: the stock market is the economy's report card. When the number goes up, the country is doing well. When it drops, things are getting worse. So when Ryan opened his phone on a Tuesday morning and saw the S&P 500 sitting above 7,500 points, an all-time high, he felt something close to relief. Good, he thought. Things must be getting better. He poured his coffee. He felt okay about the future. He went to work. Here is what Ryan did not know. Here is what the anchors celebrating that number on cable news will not tell you, because telling you would undermine the entire reason they cover it the way they do. The stock market hitting an all-time high has almost nothing to do with how Ryan is actually doing financially. And if that sounds wrong, stay with me, because what I am about to show you changes how you read every single market headline you see for the rest of your life. Let us start with the most basic question. Who actually owns the stock market? Before you can decide whether the S&P going up is good news for you personally, you need to know whether you are even meaningfully in the game. According to the Federal Reserve's Survey of Consumer Finances, the top 10% of Americans by wealth own approximately 93% of all stocks in this country. 93%. That means the bottom 90% of Americans, the people commuting, paying rent, building careers, raising children, own collectively about 7% of the entire stock market. Go one level deeper. The bottom 50% of Americans own less than 1% of all stocks combined. Not 1% each, 1% total. All of them together. So when CNBC puts confetti on the screen and celebrates a record high, they are celebrating a number that directly enriches fewer than 1 in 10 Americans. The other 9 in 10 are watching the party from outside the window, being told it is their celebration too. Ryan is not in that top 10%. And statistically, if you are watching this video, neither are you. Here is where most people push back. But I have a 401 kick. I am invested. The market going up helps me too. And yes, that is technically true. According to Gallup, about 56% of Americans own stock in some form, mostly through workplace retirement accounts. But there is a very large gap between owning stock and benefiting from the market the way the wealthy do. That gap is called scale, and it is where the story gets uncomfortable. The median 401k balance for Americans between 50 and 59 years old, people who have been contributing for most of their working careers and are roughly a decade from retirement, is approximately $182,000, according to Vanguard's How America Saves report. That sounds meaningful until you run it through the numbers. Apply the 4% rule, the standard benchmark for sustainable retirement withdrawals. And that balance generates about $7,200 a year in retirement income, $600 a month, from decades of disciplined saving. Now compare that to a wealthy investor holding a stock portfolio worth $2 million. At the same 4%, they generate $80,000 a year without touching the principal. When the market goes up 10%, their portfolio grows by $200,000 in a single year. Ryan's 401k grows by maybe $18,000 in that same year. It is the same market. The number moves the same way for both of them. The financial outcome could not be more different. And then there is the other half of the picture, the half the ticker does not show. While the market has been climbing to record levels, the actual financial condition of most American workers has been moving in the opposite direction. The Bureau of Labor Statistics reported that real wages adjusted for inflation, fell 0.3% over the past year. That sounds small. But what it means in practice is that Americans are bringing home more dollars than they were 12 months ago, and those dollars buy less. In real terms, the average worker took a quiet pay cut. Nobody announced it. Nobody framed it that way. But the math does not care about framing. At the same time, the consumer price index is running at 3.8% annually. Groceries, car insurance, rent, utilities, healthcare, everything that consumes the paycheck that is not going into a retirement account is still getting more expensive. The pace has slowed from the peak in 2022, but it has not reversed. Prices are still climbing. So you have a market at all-time highs and real wages declining simultaneously. Most people assume those two things cannot coexist. They are wrong. That combination is not a contradiction. It is a signal, and if you understand what it is signaling, it changes everything. The financial media industry is not going to explain this to you clearly, and it is worth understanding why. Every major financial news outlet in this country generates its revenue from the same institutions that benefit from rising asset prices: banks, brokerages, investment platforms, financial service companies. Their entire business model depends on you caring about market movements, checking prices, engaging with their content, and ideally putting more money into the products they manage. A version of you that treats the stock market as largely irrelevant to your personal financial life is bad for their revenue. So the framing never changes. The Dow is up, great news. The S&P hit a new record, look at that. Markets are resilient, consumer confidence must be improving. Decades of this conditioning have made the stock market number feel like a shared national score. When it goes up, we are collectively winning. When it falls, we are all in danger. But that framing was always most accurate for the people who own the majority of it. For everyone else, it is borrowed excitement. To understand how this disconnect became structural, you have to go back to what happened to money over the past 15 years. After the 2008 financial crisis, the Federal Reserve held interest rates near zero for most of a decade. They also pumped trillions of dollars into the financial system through quantitative easing. The stated goal was to stimulate the broader economy, and in one specific sense, it worked. Asset prices went up significantly. Stocks, real estate, bonds, anything you could own became more valuable. But that money flowed into assets. It did not flow into wages. The people who already owned assets watched their wealth grow. The people who did not own assets watched the price of those assets move further out of reach. When the Fed eventually raised rates sharply starting in 2022, the people hurt most were the ones who had not benefited from the cheap money years in the first place. Mortgage rates doubled. Car loan interest rates hit levels not seen in years. Credit card rates reached record highs. The cost of borrowing, which middle-class Americans depend on for homes, vehicles, and education, got significantly more expensive at the exact moment that inflation had already eaten into their purchasing power. This is the K-shaped economy. The top recovers first, grows faster, and compounds upward. The bottom stagnates or slides back. And the S&P 500 sitting at 7,500 is not evidence that the K-shape is over. It is the K-shape doing exactly what it does. There is a real counter-argument here, and it deserves an honest answer. The argument goes like this. Even if stock ownership is concentrated, a rising market still creates economic activity. Companies worth more can invest more, hire more, and eventually push wages higher. The gains at the top filter down, even slowly. A strong market is not neutral for working Americans. This is true to a degree. The wealth effect is real. But the speed and scale of that transmission has weakened considerably over the past 2 decades. Corporate profits hit all-time highs, while median wage growth for workers in the bottom 60% of earners consistently trailed both inflation and profit growth. Companies used record earnings to buy back their own stock, enriching shareholders rather than raising wages at scale. The filtering mechanism is slower and weaker than the theory assumes. And there is a concentration problem inside the market itself worth naming. The S&P 500, which most people think of as a broad measure of the American economy, is now approximately 35% made up of just 7 technology companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. When the headline says the market hit a new all-time high, it mostly means those 7 companies had a strong run. That is not a signal about trucking companies, regional banks, restaurant chains, or the industries that actually employ most working Americans. It is a tech sector report wearing the market's clothes. Back to Ryan. He finishes his coffee, gets through his day, and at some point a colleague mentions the market is up again. Ryan nods, feels that low-grade sense of reassurance he always feels when that number climbs. But his rent went up $280 from last year. His car insurance jumped $60 a month. His grocery bill runs about $40 a week higher than it did 18 months ago. His 401k balance is higher on paper, so is the cost of the life he is trying to build. The number on his screen is real. The celebration is real. The confetti is real. For Ryan, and for the roughly 90% of Americans who do not own meaningful amounts of stock, it is someone else's party being broadcast directly into their living room as if it belongs to them. That is the lie. Not that the market is fake or rigged. The market is exactly what it is. The lie is the story wrapped around it, the one that says a rising market means Americans are doing well, that hitting a new high is shared good news, that the report card with a good grade belongs to the whole class. That story has been wrong for a long time, and nobody with a financial interest in keeping you watching the ticker has any reason to correct it. Now you know. Drop a letter in the comments. Drop A if you check the market regularly, and it genuinely affects how you feel about your finances. A good market day actually changes your mood. Drop B if you have mostly tuned it out. You track your own net worth separately, and the S&P is background noise. Drop C if you are somewhere in between. You know the headline number does not tell the whole story, but you still feel the pull when a big record flashes on screen. No wrong answers. I read every single one.